Hi everyone. I'm gonna share my screen here. All right, Eric, you should be able to see my screen.
I've got it. Yep.
Okay. Whoops. Let me move this around. Okay. Oh, yeah, I might need to start the webinar. Okay. Okay. Now I was like, no one's joining, and then I realized I got to start the webinar. So yikes. Hopefully I get a little better as we go. So okay, now I see people are joining now. So today's a good day for a webinar because it's pretty cold in Iowa. So I think it was 2 degrees up in Watertown, South Dakota, Joe said. So
yeah, we were 5 with a -20 wind chill and snowflakes in the air most of the morning. So
yeah. So well, I think we'll get started here, and I'm sure there'll be more people joining us as we go, but I'll want to keep us on schedule. So my name is Matthew Cruz. I work with Comstock Investments, and joining me is Eric Ralph. He is our broker in our main office in Royal, Iowa. I'm based here in Des Moines, and this is the Introductions to Options Trading webinar. And so we're gonna kind of be mostly going through the basics today. Trying to keep it relatively simple. It's mostly for those that are kind of beginning and trying to learn about options trading. And if you're a options trading superstar, that's fine. This might be a little boring for you, but it might maybe help reinforce some of the basics. But so I think we'll get started here. I do got to always show my disclaimer here in the futures trading industry, because it does involve risk of loss in trading futures and our options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance, as they say, is not indicative of future results. So it's kind of jumping right in here. And by the way, there's a place to type in questions in the Q&A box at the bottom, and so feel free to type those in at any time. We might not get to them towards the end, but I know sometimes they take a little while to type in. So so Eric, I'll just kind of get going here, and if you see that I missed something, feel free to interrupt me, jump in. But so just to clarify some of the basics, why we're doing what we're doing with hedging. The main, I think a lot of people sometimes confuse hedging with trying to make more money. A lot of times that's really not the case. What you're trying to do is transfer risk and lock in current prices. You're not trying to increase profits so much as you are locking in existing profit margins, and that's kind of the main reason for using options as an option strategy in your marketing toolbox. It does downside, I suppose, of hedging is it does limit the upside, but of course it helps protect you from the market downside with what can be minimal cost depending upon how you do it. And of course, one of the main hedging tools that we use is futures and options contracts, pretty common in our industry. So kind of starting out, just learn some of the basic option lingo. These pretty important to learn just because they make up what the premium is. And a lot of times options get compared to insurance. There are some differences, but it's a somewhat fair comparison, I think, because the premium that you're paying for the option would be similar to what you'd be paying for any type of insurance product, whether it's a car insurance or vehicle insurance, and we'll kind of explain why. But the items that make up the price premium for that option are like the strike price. Of course, the strike price is what specific price in the underlying futures contract that you're identifying to either put a floor in the case of a put option. And and so if it's well in the money or well out of the money, that's going to have a huge difference in what the price premium is going to be. Of course, how much time is left until that option contract expires is going to have a big impact on what the premium is. If it's several months out, if it's new crop corn, for example, that expires, I think, the end of December, or excuse me, end of November, versus a contract in May that expires, in another month or two, that's going to play a big difference. The volatility of what's going on in the market, if corn is trading sideways and just has a couple of cents of variations each day, that premium is going to be cheaper versus if it has a 10, 15, 20 cent price volatility every day. And the example I would give is, the cost to buy home insurance would be cheaper if there's a pending hurricane coming. A lot of those along the southeast coast of the United States, the insurance salesman is going to demand a lot higher premium for home insurance up to the point of the hurricane versus after the hurricane passes, right? Just because there's a lot more volatility baked into the market, they're unsure what the devastation is going to be. And so it's kind of similar concept to options trading. If there's a big report coming out, there's going to be a lot more volatility in the market, and that could increase the premium versus after the report comes out. And then, of course, the intrinsic value, again, the difference between the underlying futures contract price and the strike price. And so, as we talked about, kind of the distance, how far away you are from what the current futures price is, if you're really close or far away, and that's like anything with insurance. The more coverage you want, the more expensive it's going to be. So what specifically are options? The options contract, you've probably heard this, is the right but not necessarily the obligation to buy or sell a particular futures contract at a specific price. And so options contracts, you're essentially buying the right to use a futures contract. And so just like futures, it's all standardized, right? So it's futures contract is 5,000 bushels for corn and beans. If you're buying options, your risk is limited to the premium, and so there's no margin calls. If you pay $1,000 for that premium to buy that option, your maximum risk is that $1,000. Now that's not the case when you're selling options, and we'll get into that a little bit. When you're selling options, your risk is unlimited. And so that's kind of nice to know. If you were to just buy a straight futures contract, you're beholden to the market, and so you could end up getting margin calls. But in the case of buying an option, your risk is limited just to that premium. So yeah, we kind of talked about this. When you're buying an option, you're creating essentially a floor in your production. And so if you say, hey, I want a strike price of $6, I want to buy a $6 corn put, you're putting a floor at that $6. And so you're essentially never going to receive less than that $6 for that corn. And depending on what the market is doing, that could be expensive. And so it's up to you to kind of decide what you want to pay. And so obviously a $6 corn put is going to be more expensive than a $5 corn put. And so, yeah, as it says here, you're essentially taking advantage of what futures prices are doing without actually getting in on taking a futures position. The advantage of selling options, and we'll get into this a little bit more, is it gives the opportunity to earn some income. That's why a lot of people like that, and we use a lot to kind of offset the cost of buying those options, to offset the cost of those premiums, because depending on what you do, it can be pretty pricey. But we can't say enough that anytime you're selling an option, you do face a lot more risk. But a lot of people do it because it's, money in the pocket, and some people follow that strategy. And so, another advantage is you're buying these options, can be avoid storage costs. And I know in my case on our farm, there's not always on-farm storage available to me. Either I'm kind of beholden to if my father if he's gonna use the storage or not, and or my uncle. And so it kind of leaves me with either selling off the combine or using commercial storage. And I don't necessarily like commercial storage so much. And so using options is potentially a cheaper way to gain on the potential upside. If you're going to buy a call, for example, that's could potentially, not necessarily, but potentially be cheaper than storing your crop and paying that commercial storage. And so it just gives you another option there to consider. So kind of go through some of the downsides of the options. Be upfront about that of course it can be expensive, as we talked about, but it depends on how much coverage you want, right? It's just like insurance. If you have a $200,000 home, and if you want $300,000 in coverage, that's going to be more expensive, obviously, than if you want $100,000 in coverage. And so obviously the less risk that you want to take, if to reduce that risk, it's going to cost you more, and so you got to pay for that. The other challenging thing with options is there's a time limit, right? And every day that goes by, the value can get a little bit smaller, just because the eroding time value that you need to consider. And so if there's 100 days left, or 200 days, or 20 days left on that option, you need to be aware of that, because there's a time value to it. And your broker should be able to help you track that, to take that into consideration. Now, you don't get the money until it expires. It might show up into your account, but it's not necessarily money you can just cash out and take it and run. You got to stick with it until that option expires, or you offset it, meaning you get out of that position. But the money should show up there in the account if you're, as an example, if you're selling options. So that's just something to consider. I know the thing that's challenging for me is options are not necessarily a quick way to get rich. It takes a lot of patience to do it right, and to manage those options. And so a lot of times those positions take months for them to kind of work through and reach its conclusion. And so a lot of times people don't realize how long that can take. So just taking a step back and when does it, and asking yourself, when does it make sense now to actually buy or sell an option? And the first thing you kind of have to do is decide, well, which way do I think the market's going to go? Do I think it's going to go up, down, or sideways, right? Because there's three different ways that the market can go, and everyone's aware the market can go up or down. A lot of times people forget that the market can just go sideways, and maybe 70% of the time the market trades sideways. And there's ways to trade that with options too, and we'll kind of get into that a little bit at the end of the presentations. But it's important that the trend traders that I know, as a general rule of thumb, they look to buy those options when the market is at kind of extreme price levels. I feel like that's when we kind of see the better value in those options, and maybe Eric can comment on that, and if he has a different opinion, versus when you're selling those options. So I'm more of a visual learner type guy, so I put together some of these graphs to, if you're buying a call, and I'll break this down here in a minute, but this is just to give you an example of when to, the best time to buy a call is at the extreme low, and when you think the market is going to go higher, because that's when that call is probably the cheapest at this level, because the market hasn't gone up yet. And so when you're buying a call, you're taking advantage of that rally. Kind of similar but opposite situation when you're buying a put. You buy that put when you expect the market is going to fall. And so you could potentially argue that right now is a good time to buy a put, because obviously the market has rallied a lot today, and it's arguably at a more of an extreme level. If you look over the last several years, it's not often that what did we close today in March corn at 674 3/4. So it's not very often that in the history of corn and the history of marketing that we're at those levels. And I was actually just talking to a grain buyer today, and I was asking him what he was seeing farmers doing, and he said he's getting a lot of people taking $14 for new crop right now for soybeans, because whether you were, the way he put it in a good way, he said whether you're 40 years old or 80 years old, you've never sold soybeans off the combine for $14. Now that's not to say come next November they could be 15 or 16, but he was getting a lot of people interested in locking up sales at $14, because in the history of farming in the Corn Belt, no one's ever been able to lock in $14 at the combine right now. And so
Yeah, certainly not in February.
Yeah, right. And so yeah, maybe getting a little bit off topic. So now we're looking again at the opposite side of that. When you're selling the put, you expect that market to rise or stay flat, and so you're ideally want to buy in at that support level at those extremes, and then again the opposite when you're selling a call. So breaking it down, this is kind of the meat and potatoes here. There are 4 basic types of options. You can buy a put, sell a put, buy a call, sell a call. Now, when it all comes down to it, these are your 4 basic strategies. Now you can mix and match this 100 different ways or 1,000 different ways, which makes it more complicated. But at the end of the day, these are kind of your 4 basic option strategies. And so starting here with the first one, you're buying a put. Again, that holder of that put option has the right to sell or go short a futures contract at a specific price, which when you're buying that put, you're choosing what that price is, and you're choosing when it's going to expire. You choose that. We've talked about how it's compared to insurance, because you're deciding what amount of coverage or premium that you're willing to pay, and so you have a very specific and defined risk of what you're willing to live with. And if you think, this is too much risk, you can of course change that. It comes down to how much coverage you want. A buyer of options can exercise the right to exit those underlying futures positions, and that's something that's probably better than actual regular insurance. There's still you can still offset these positions if you change your mind the next day or a month after you purchase an option. It's salvageable, right? You can still get out. Now that's probably not as easy to do if I buy car insurance or home insurance, and I pay the insurance salesman, and then a week later I decide that my house is going to be fine. I don't need to buy home insurance. I'd like to get that money back, and that's probably not as easy to do. But in options, you can, assuming there's liquidity, you can get out, just like that. So, and again, you have to keep in mind that there's time decay. Every day the value is going to decrease, and so even assuming that the price remains the same, so you have to keep that in mind. So this is again, since I'm a visual type guy, I realize this chart is kind of outdated because we're it's just showing strike price of $3.80 in corn, but the concept is still the same, that if I bought a $3.80 put option, I'm establishing a floor here, right, as the market rose. And at that time, it made sense. This is several years ago. It showed 2018, actually. It shows you the date right there. That I'm saying, oh boy, that market's at 386, and I'm worried it's going to come crashing back down. We had a good run there, so I'm going to put a strike price or put a floor basically at that 380. So buying a put protects you to that downside. And again, you're ideally looking to do that on when the price is rallied and potentially reach an extreme. And your next question is, well, when do you know that extreme is? And that's of course the $1 million question, when we don't always know. But luckily we have Eric to tell us when that is. So, so moving on. So we talked about buying a put. Now we're talking about selling a put. So again, the selling the put is different than buying it, where in buying the put, your risk was limited to just the premium you paid, but now you have unlimited risk anytime you're selling any type of option. If you're selling a put or selling a call, you have unlimited risk, and you get that money kind of up front in your account, but you don't, there's, depending on how much time is left, it could be a while before you get to spend it, and you don't know what the market is going to do exactly until then. And so if the market goes against you, you're still contractually obligated to take the opposite futures position if and when that the buyer chooses to exercise that option. And so a lot of times we use it to help offset the cost of buying those options, and so that's pretty common, but but it's definitely a lot riskier when it's what we'd call like a naked option strategy, where you have that unlimited risk. So again, it has that time decay, but when you're selling that option, it tends to work more in your favor. So again, another chart shows you the opposite of what's happening. So here we sold a put because we thought that the price is gonna go higher. In this situation, in a scenario, it could be used to pay for a call or put. And so that's pretty common in our industry. So now we're going to talk about buying a call. So the holder of the call option has the right to buy or go long futures contract at a specific price on or before the expiration date. So this is, I gave the example kind of at the beginning of the webinar when we started, that I don't necessarily like paying commercial storage, and I don't like to be tied into that elevator. I can sell that grain and then buy a call if I'm still thinking that the price is going to go higher, and that could potentially be a cheaper way versus paying for storage. And similar to buying the put, it's comparable to insurance buying, but a buyer of options can exercise the right to access the underlying future position. So again, if you buy that call and a week, a month into it, you change your mind, you can still hop out. Now you might take a hit on that, depending on what the market did, but you can still get out of it, assuming there's enough liquidity in there. You don't want to be buying in the wrong strike price or the wrong month if there's no liquidity either, and your broker should be able to kind of help you with that. So again, it's giving a visual depiction of what I'm talking about here. So the market is now in this scenario has come all the way down here to this 360 price level. And so if I'm thinking, okay, I'm thinking the market is bottomed out here and it's kind of building a bottom, it's going to turn around, and I want to buy a call with a strike price of 384. And ideally you're doing that at this extreme low here, because it's going to be cheaper for you to buy it. And but the further out that you put that strike price, the less chance of it getting exercised too. So you have to kind of weigh that option too. So, but buying a call is just a way that you would participate with the upside in the market. Our last option, basic option strategy, is then selling that call. And again, you're taking unlimited risk anytime you sell an option. And so it's similar to selling the put, just in the opposite direction. So you collect that premium on what you sold, but you can't quite spend it yet. And again, this can be done, for different reasons, but one of the main reasons is, just to help offset buying an option. And it does, again, have that time decay, but this should work in your favor. And here is our go-to visual depiction, where you're establishing that strike price. And the higher that you go, the cheaper it is, but the less chance, again, that you're going to get that price exercise. So when you sell a call because you think the market is going to go lower, and you can help pay for the call or put that you purchased. So another thing to consider when pricing your options, are the premiums paid, and those again are really driven a lot by what the current price is and whether it is in the money, at the money, or out of money. So what do we mean by that? So if it's in the money, your strike price is is less than the futures price, so it has a positive value. If it's at the money, the strike price more or less equals the future price. And if it's out of the money, the strike price is greater than the futures price. And so again, the more out of the money that it is, the cheaper that premium is going to be, right? Because there's less risk. And the more that it's in the money, the more insurance, the more coverage that you're buying, and so that becomes more expensive. And so that's an important thing in determining your option strategies. How far in the money do you want to be, or how far out of the money do you want to be, or do you want to buy it right at the money? And these are a little outdated again, but just to give you a visual depiction. So if I'm, if corn is at 386 and I'm buying an at the money put option, that means I'm buying it right at roughly that 386 level. And then I want the price, at least for that put option to work, the price needs to drop. And if it drops below that strike price, which is at the money, that means that the option now becomes in the money. Now that's a good thing for your hedges, but that also means if you have any unsold grain, that unsold grain is obviously going down in value too. But as we talked about at the very beginning, the whole point of hedges is to lock in that profit margin. And so just kind of gives you a visual depiction of how that works. And so the opposite of this is the call options buying in the money. You want the strike price to be greater than the futures price. At the money is the same, strike equals the futures price, and out of the money, the strike is less than the futures price. And so similar, but kind of opposite directions. Now that I bought that call, if I bought a call at 386, for that to be in the money, I want the price to go up and be above that at the money level at that 386. And if the price drops, it starts to move out of the money. So something else to consider when buying those options, you want to be aware of what your cost is and your potential break even. And these are a little bit more updated here as of last week. I kind of went and looked at what does it cost right now to go do just a straight buying a call option right now at 690. And as of last week, and I'm sure it changed a lot today already, but I think that premium costs about 27 cents. and then you have another penny or so for the commission for your broker. So you're adding that 28 cents to this, and so your cost of that brings it to $7.18. The opposite side of that, if you're buying a put option, I went and looked, and for a $5 put option, it cost, and this is for new crop, by the way, December corn. And again, it depends if you're doing May or December, what price you're doing it. So it costs you 13 cents for that premium, and then a penny for the commission. And so that brings your break-even cost down to 486, from that 5 down to that 486 on that. And again, you can offset those. If you think, oh, that 27 cents, that's expensive. There's ways to offset that by selling options, as well, as we've talked about. But it's important to note that option buyers can walk away from the option if it's not profitable for them. If they decide to get out, a week later, what's that? But after it's expired, then you have to either choose to exercise it or especially if you're selling that option. So in this case, if you're buying those options, your worst case scenario is the amount that you paid on that premium. So let's talk about what if worst case scenario, if you're selling options and the price goes against you. The option sellers still have to honor the option that the buyer then chose. So when you're selling options, you're basically taking the role of the insurance company. And if something goes wrong and the house burns down, you now have to ante up and pay that. Pay for the amount of insurance that they purchased. And so now, as we talked about, it has salvage value. So a week or month into it, whatever, you decide, hey, I'm changing my mind. The market scenario looks different. You can get out. But if you stay into it up through the point when the contract expires and it goes against you, you do have unlimited risk when you're selling those options. I think that's where you hear a lot of those horror stories. And so some people might get confused when it comes to options, but that's only when you're selling those options and you don't have another option to offset that. So when should I sell options? When does it make sense to do that? Potentially when the market is trading sideways or remains flat. But one of the main times that we like to use it is just to cheapen a trading strategy. And this example is kind of outdated, but back in 2018, this was just an example where somebody bought 5 October short dated puts at a strike price of 360, and that was maybe considered expensive for them, but they were able to sell a single October call to offset the cost of those puts. And so that can happen where you buy 5 puts and you only sold 1 call to help offset that. And so they actually cost them 0 to then in this specific example. That's why I chose this example, just because it doesn't necessarily have to cost you anything in premium. There are strategies and ways to do that, but of course it depends on what level of risk that you want to do. And so that's why I thought that example was pretty interesting, and it was really popular and worked well for us at that time. Again, selling a put makes sense in these specific scenarios, as we've kind of gone over.
Might interject on that, selling those options. You mentioned earlier about the increase in implied volatility coming into reports. Anytime you have an increase in the volatility, the premium for an option goes up. Oftentimes leading into USDA reports, which we all know can be non-events often. It'll just suck that vol premium right out of the options. So that's a time where I have several clients who will sell a put and a call. in hopes that one of them, if it is an extreme move, one of them wins, obviously, where the other might lose, but both of them decrease that vol premium. And so anytime you have this super heightened implied volatility like we have right now after days like today, it's a good time to consider it as a spec trade or even as a partial hedge.
Yeah, it's a good point. It's important to know that you need to be aware of how to liquidate these option positions. Liquidating this is another way of just saying offsetting or getting out of the option position that you're in. If you sold the option, you got to buy it back. If you bought the option, you have to sell it. And so there's just things that you need to be aware of. Exercising the option occurs after the expiration, and you'll know when that expiration is, or you should at the time that you get into that option trade. This is, if people want to try and track a little bit better what option prices are doing, our brokers have access to this information in real time, and maybe not bar charts, but a more advanced program. But I just put this up there, this website, if people wanted to go onto bar charts, and I believe it's delayed quotes, but it's just something that give you an idea to kind of look over. And but this is just an option matrix to kind of see the different things that we're looking for. So when I pulled this up last week, so you can see the December corn. This is December new crop corn. It expires November 25th. And so when I did this looks like I did this February 16th. You can see right here. At that time, there's 282 days left on that particular contract. And so if you look at buying a $5 put, that's what this is here. It's going to cost you at that particular time 13 cents is what that is. And so it was kind of trading between a high and a low of that day. And so this is just a very simple option, or I should say simple example, so you could see if someone was interested, like but I want to put a floor in because we're reaching these extreme levels right now, and it's getting pretty starting to get cheap, but so if you say, okay, no, $5, that's too low, corn's already at $6.74, I want to do $5.50. Well, that's fine. You can see in the put how we went to 32 cents. So to add another 50 cents in coverage takes you from that 13 cents to 32 cents in cost, just buying a straight put option. But you're establishing a floor at 5.50, and how often do we get opportunities to do that? And again, there's ways to cheapen that up, that I'm sure, and I think Eric here at the end will give us some examples of that.
Might show them the open interest there while you have that.
Oh yeah, here the open interest. I'll let you talk about that, but the open interest is just the number of outstanding contracts, basically, at any given time in that particular contract. And that's something you want to look for too, I think, just to make sure you have enough liquidity in the market, because otherwise it can be a little bit hard to get in and out if there's not many people trading that. So Eric, do you have anything you want to add to that?
Yeah, I think this is a pretty good example because you have the 510 call right underneath that highlighted put with an open interest of 754. And in the corn market, if you're looking at an option that has less than 1,000 open interest, you would stand a risk of getting into something that's not liquid enough to get out of if the market doesn't go your way. So then you could potentially have to ride something to expiration, which may not be what you're looking for. So it's something to definitely keep in mind when we're looking at buying or selling options. We want to make sure there's a fluid market. Yep,
exactly. Yeah. So if there's a fluid market, you should be able to get in and out pretty well, but it's something you need to pay attention to, because otherwise you get caught in something that's hard to get out if there's not enough open interest. So these are just some basic put option examples. You know, so if I'm a farmer and I have 100,000 bushels and I want to, you know, hedge at this 366 level, excuse me, 360 level, I need to buy 20 December corn puts, 20 because there's 5,000 bushels in each contract, right? You know, back at this time, this costs about $400 per option. And so you kind of see you're taking your strike price of 360 minus the cost of those at their time of 8 cents. And so your break even is at 352. So if the price drops to 320 a bushel when the put expires, you know, your crop inventory decreased by 46 cents per bushel. You know, so that's bad. However, once the market price becomes in the money, and we talked about that, when the price dropped below that strike price, when it became in the money at 352, the farmer begins gaining on his put option. And so he gained 32 cents on that trade. So what's the result of that? The farmer has protected the equity in his cash crop, and he didn't have a single margin call to do it. I know there's a lot of negative mentality when it comes to margin calls, and so when you're buying those options, you can avoid those. You know, he picked up another 32 cents per bushel compared to if he had done nothing at all. You know, had the price gone up, had it gone against him, you know, he would have gotten more for his physical crop that he potentially had in the bin. But he wouldn't have got a margin call. He would just been out that money that he paid in the premium, you know, which was $400 per option contract. So this is not a great example, probably, you know, partly because it's outdated. You can see this is back on September 11th in 2018. But you know, can cheapen up by selling options as well, but again, that adds more risk to it. Similar example back on September 11th in 2018 of selling a call option. You know, again, you're hedging that same 100,000 bushels, and the farmer wants to reown that crop on paper. Let's say he sold his grain. He wants to reown it by buying call options with a strike price at 370. You know, at that time it cost him 10 cents per bushel with a strike price of 370. So his break even right is 380. So if the price, let's say in this example, goes to 420, you know, he's picked up an extra 40 cents, you know, to do that. And so the result of that is the farmer is participating in the market rally without actually owning any physical grain and without any margin calls. Had the price gone down, again, the only thing that would have happened is he just would have been out the premium that he paid for those call options, which was in this example at that 10 cents a bushel was $500 per contract. So now we start to get into where things get a little bit more complicated, because you can combine all of these options to do different things to cheapen them up or reduce your risk. And so you can buy and sell them. That's where you get into your 2- and 3-legged spreads. You can either combine a futures contract with other options. And so the options are really limitless, and yeah, it's hopefully your broker kind of help you do that. So one popular option strategy is the bull call spread, and that's actually been popular right now, where you're buying a call at the money in the front month, and then you're selling a call out of the money. And so this is kind of an example. So if you bought a at the money call at 560, the goal, I think, and Eric, correct me if I'm wrong, the goal would be to see this front month move up quicker versus the selling this call, you know, eroding in value. So you should be gaining more on the front month call that you purchased, more so than the selling out of money call. And so this is just an example of that. And so you want to do that in a rising market. And I think you're seeing that right now happen. And this is just an example about back in crude oil back in 2018, where we saw that happen a lot in the market.
Without getting too complicated with it, the delta of the closer to the money. So if you bought it at the money, you have a higher delta than something that's, say, in corn 50 cents or $1 out of the money, or in crude oil $3 or $5 out of the money. And you're going to gain whatever the difference in that delta rate is. So you may own something with a 50 delta, meaning it's earning 50 cents on the dollar, and you might sell something with a 20 delta, meaning it's going to lose 20 cents on the dollar. So effectively, you're cheapening your upfront price to gain that 30 cents on the dollar, something like that.
Yeah. So bear put strategy is what you would look to do in a falling market if you think the market is going to be going down, and these spreads are basically just a way to reduce your risk. I think, you know, they depending on what price you get in, you don't usually make as much money, but they're a lot less risky, I think, is a general statement. Yeah, and the margin money, you know, to buy into them is usually a lot less because it reflects that. And so in this case, you're buying a put at the money here, and then you're selling an out of the money put down here. And so as the price erodes or drops, you're gaining, hopefully you should be gaining more on the at the money put that you purchased than you are losing on selling the out of money put here. That's the basic strategy there that you see in a falling market like that. I hope you like my picture to help give you an example of a straddle option. And so that's when you're it works best in it when the market is going sideways, right? Because it's not always going up and down. And so you're taking both sides of the market. And when you're selling a call and put at the same strike price. And so you're basically saying that I think the market's going to continue to go sideways. You know, and the risk of that is fairly moderate, because either way it's going, you're going to make one way and lose and lose on the other way. And so you're kind of hoping that the market is just going to keep trading sideways, and you'll get a you know, keep that premium that you sold. A strangle, again, this is when you're expecting a big price move. The market has been trading sideways, but you think, boy, this is gonna eventually it's gonna break out of this trading range, and it's gonna break out big time. I just don't know which way it's gonna go. There's an option strategy called the strangle. And so if the futures price is, this is at cotton, and so if the futures price is at, you know, this 81 cents at the time, you can buy out of the money call, and you can buy out of the money put, and so you're looking to whichever way it's going to go. Once it breaks out of that trading range, you're going to look to gain on that, and potentially gain more than what you're going to lose on the opposite end of the option strategy,
or leg out of the other side.
Yeah, yep. Or once it breaks out, you can hop out of that, offset that position. So that's kind of the end of my part. I'm going to hand this over to Eric, and he's got some more, I would say, up to date options strategies that he's been using and what he's looking for and what makes sense. So he'll talk here for a few minutes, and then we can take some questions then at the end if anybody has them. So Eric, I'll hand it over to you.
Okay. Yeah, so I just put together a few things based on prices today at the close. This one is means of hedging new crop grain. Simplest way is outright buy a put. Problem is November's a long ways away, so you're paying for a lot of that extrinsic value or time value. So to buy that $14 November put, which is still quite a ways out of the money, but just sets a profitable floor, it's going to cost 85 cents outright, which you know, gives you an effective sales price of $13.15, give or take your basis. Similarly in the corn, this is closer to the money. The $6 corn put costing 55 cents today gives you a 5.45 sales price. Again, plus or minus your basis. And the ranges of basis from Eastern Belt to Western Belt to Mid-South to Southwest is just unbelievable. So this is definitely something that you have to look at what works for you in your area based on your basis levels or what would typically be normal. The other strategy that I have several traders use is they will sell calls as grain producers. They'll sell the new crop calls in either December corn or November beans. The nice thing about doing that is you're collecting premium with a lot of time value from this point of the year. I guess it's something you wouldn't want to do on a large percentage because, as Matt pointed out several times, your risk is unlimited when you're selling options. The best case scenario here is the market keeps going up as a producer, and these positions do have to be margined, and you do lose money on these because you're only going to do a small percentage. So that's another thing to consider. However, it does give you a nice little bottom line pad if it goes your way. And then we can work on other strategies on higher percentages. But most of the people that do this do in the 10, 15 to 25, 30% range. So they're not going all in, especially not knowing what kind of a crop they may or may not have. December $7 calls today were 27 cents. November $17 calls today were 46 cents. So you can see that's a fair amount of premium to collect, and that is still quite a ways out of the money. That November $17 is out there and still worth a premium. And the flip side of that is, you know, you can get out whenever you need to, as long as you are in a fluid market, which as brokers, we try not to put our clients into markets that aren't. So most of the time it will be possible to get out fairly easily. So one of the things that Matt mentioned when he was going over the different strategies is combining options with futures. I do this for a lot of people. We'll buy corn, we'll buy soybeans, we'll buy cattle, or sell them, and then take the opposite position in the options market. So the typical trade there would be, we're going to buy corn and we're going to buy an at the money put or something within 10 to 20 cents out of the money. But today I could buy the May corn and buy an April 660 put for 20 cents. Now, from now until March 25th, when that April put expires, I have a 20-cent downside risk. So what I would do is, if the market keeps shooting higher, like, you know, the kind of movements we've been seeing recently, 20 cents in a day is a little out there, but, you know, when you're getting 8, 10, 12 cents a day, you can use percentages of that gain in the futures to keep your puts closer to the money. So what we'll do is we'll have working orders all the time to roll 20 cents higher with our put option, so we're closer and keeping that protection near our current price. We'll roll in 20-cent increments and do it for a nickel. So if we can roll, say the market keeps going higher, we can roll from the 660 put to the 680, keep that protection close, do it for a nickel, and keep going. And hopefully that's how it would work out. If the market crashes back, obviously you have the put option, you have the short position at 660, you bought the contract at 660, so your maximum risk is your 20 cents that you paid for that put. And then when we start to run out of time, then obviously then we have to pony up and pay 12 to 20 cents and buy another 30 days on that option. Same way with the beans. You could buy the May beans today, buy at the money put for 42 cents. You get 42 cents of downside risk. And if the market keeps shooting higher, have your orders always working to keep those puts rolled up behind you. Spend a nickel, go 20 cents, and just keep doing it as long as the market keeps going your way. There should be at least one more, I think. Oh, yeah. Rising fuel prices been a big concern for people. They've been trying to figure out how to hedge against it. A lot of people don't want to pay for, well, one, they don't want to pay the margin for the futures contracts, and two, they don't want to be subject to that kind of risk. And so I've been buying a lot of crude oil calls, fairly short time frame stuff. We'll roll if we need to. But that way, if obviously the energy complex generally works in unison, where crude oil, gasoline, and diesel fuel all move in unison to a degree, not penny for penny, obviously. So it's not a great pinpoint hedge, but it's a general capture. If the market's going to run away, if Putin invades Ukraine and the market just is overreactive and we're trading $120 crude oil in 30 days, you would sure have some significant upside capture here that would offset your increased fuel costs, whether it be for planting or harvesting. I think most have planting already locked in, but they definitely need to do something for harvesting. So we're buying crude call options, and these are current today for most of the day. Crude was moving pretty good, as you know, Matt. But for most of the day, this was pretty accurate. You get the April $90 call for 463, and those are 1,000 barrel contracts, so that's $4,630. You could get the April $95 call for 3,500, the May 90 for 6620, and the May 95 for 4330. And you mentioned the bull call spreads. You could do this example, open up a $5 window into April for $1.13 or $1,130. You could open up that same window in the May for $2,290. So pretty reasonably affordable ways to avert a catastrophe on fuel costs come late summer or fall. And we'll just roll these. I know the April-May timeframe doesn't do you much good for harvest time, but we don't want to spend $12,000. We'll spend $5,000 and we'll roll. So.
Well, that's we've been going for almost an hour now, so I don't know if anybody has any other questions. The time went pretty fast, and so yeah, we'll maybe give it a minute, see if anybody has any questions they want to type in. But otherwise, you can give Eric a call at that 712-227-1110 number, and we got our email address there as well. So I don't know, Eric, do you have anything else you want to add to that? We're going to send this recording out, by the way. Probably get it by tomorrow, so people can rewatch this. So
yeah, I guess the only thing that I would highlight right now for options is there's a lot of products, particularly ag products, with really high implied volatility. So there's some value in the options that isn't normally there. We're seeing it day in and day out. We're seeing it in all primary grains, hogs, feeder cattle, occasionally the live cattle. It's been kind of unique. It's interesting to look at the volatility every day.
Well, I think we've wowed everyone. So Eric, thank you for joining us, and
enjoyed it.
Does anybody has any questions, feel free to give us a call. Thank you.